Hello traders, you're welcome back to the channel. If you are looking to take your trading strategy to the next level, then this video is just for you. We are going to dive into one of the most crucial tools for traders who want to manage risk and understand market sentiment, okay? So specifically, we're going to be looking at the Implied Volatility Index, all right, or the IVI. Before we jump into the details, don't forget to like this video if you find it helpful, and make sure you subscribe to the channel so you won't miss any of our future trading tips. All right, now let us get started. Okay, first things first, what exactly is the Implied Volatility Index, or IVI? Simply put, it is an indicator that shows us the market's expectations of future volatility based on current options prices. In the world of trading, volatility refers to the amount of price movement an asset is likely to experience in the future. When volatility is high, we expect larger price swings, and when volatility is low, price movements are typically more subdued. So the implied volatility index measures the expected volatility for a given asset or market, and it does this by analyzing options pricing. Options, as we know, are sensitive to changes in volatility. So the price of options can give us clues about how much price movement is expected. In essence, the IVI reflects market sentiment. If traders expect large moves, the IVI will be high. If the market is calm, the IVI will be lower. Okay? Now let us break down how the implied volatility index is actually calculated. The IVI is derived from the prices of options on the underlying asset. So whether that is forex, pairs, stocks, or commodities, it reflects the premiums that traders are willing to pay for options contracts. All right. When the price of options rises, it means that traders are experiencing bigger price movements, which pushes up implied volatility. Conversely, when options prices drop, implied volatility decreases, indicating that traders expect less price movement in the future. It's important to note that the IVI is not a perfect predictor of price direction, okay? It doesn't tell you where the market is headed, just how much movement is expected. This can be especially useful when deciding whether to enter or exit positions, and when to choose which strikes and expiration dates to trade with. Okay, so how can we use the implied volatility index in our trading strategy? Well, the IVI can be incredibly useful when you are making decisions about trade entries and exits and managing your overall risk exposure. Here are a few key ways to apply it. The first is identifying high volatile, or rather high volatility environments. When the IVI is high, it means that the market is expecting bigger price swings. Alright? This could indicate the potential for a strong trend or a volatile market environment, which may present lucrative opportunities for certain trading strategies. For example, if you are using momentum trading, a high IVI could signal that there is a good chance of a breakout in the near future. However, keep in mind that high volatility also means higher risk. So it is important to adjust your stop loss levels and position size accordingly. Okay? Also, waiting for low volatile periods is important. On the other hand, when the IVI is low, the market is expecting less price movement, and that typically signals a sideways market or a period of consolidation. This could be a great time for range trading, okay, as price is more likely to stay within a defined range. If you see low volatility, you may decide to wait for more favorable conditions before entering a trade. All right, now talking about volatility contraction and expansion. Another strategy is to look for volatility contraction, which is when the IV drops sharply, and prepare for an expansion of volatility. So the market often behaves in a way where after periods of low volatility, a sharp expansion is likely to occur. By anticipating this, you can position yourself ahead of time to take advantage of potential price movements. Now, the IVI is best used alongside other technical indicators like the Relative Strength Index or MACD, to confirm your trade setup. Basically, if your momentum indicators are signaling an overbought or oversold market and the IVI is showing rising volatility, you might have a good chance of a profitable trade. Okay. Now let's talk about how to interpret changes in the implied volatility index. If you see the IVI moving higher, this could mean that the market is becoming more uncertain or that traders are anticipating some kind of event like an earnings report or economic announcement or geopolitical events. During these periods, the market can experience significant price moves, so it is essential to adjust your trading strategy based on the level of volatility. Now, if the IVI starts to decrease, it suggests that traders are becoming more confident in the market's direction or that they expect lower price fluctuations in the near future. So, lower IVI readings can be a sign that the market is either in a period of consolidation or preparing for a trend reversal. So this change can also indicate that the market sentiment is shifting. For example, if implied volatility suddenly drops after a period of high volatility, it might signal that traders are waiting for clarity on a particular asset or that uncertainty has begun to settle. So here are some final tips for using the implied volatility index effectively in your trading. First of all, combine it with price action, okay? While the IVI gives you an idea of potential price movement, always consider the price action and overall market context. Look for patterns and price levels that support your strategy, okay? And then keep an eye on market events because major events like economic data releases or central bank announcements can drastically affect volatility. So use the IVI as a way to anticipate these changes and adjust your trades accordingly. Finally, watch for divergence. Sometimes the IVI can show a significant divergence from price action. If the price is moving in one direction but volatility is low, it might signal an upcoming change in direction. So watch for these clues to prepare for a potential breakout or trend reversal. In conclusion, the implied volatility index is a powerful tool for understanding the market's expectations of future price movement. By analyzing the IVI, you can gain valuable insights into market sentiment, adjust your risk management, and make better informed trading decisions. Whether you're trading stocks, forex, or options, integrating the implied volatility index into your strategy can provide a significant edge. But remember, it's always important to use it in combination with other indicators and to keep an eye on the broader market context. Okay? If you found this video helpful, make sure to like and subscribe for more tips and strategies. And let me know in the comments if you've used the implied volatility index before, or if you have any questions about how to apply it to your trading. Thank you for watching, and I'll see you in the next video. Happy trading.